Former President Trump's sweeping tariff ultimatum has triggered a worldwide backlash and sent shockwaves through markets and businesses. Could this bold move isolate the U.S. economically more than it protects it? On May 17th, Donald Trump announced a dramatic policy shift. 150 countries would be required to pay up to keep trading freely with the U.S. This move, framed as sending a tax invoice to the world, received immediate and unified rejection. Nations from Japan to Germany refused to comply, some freezing negotiations, while others pivoted toward new trade partners like China. Global markets responded with sharp declines. The S&P 500 dropped 5.3%, and the Dow Jones plunged by 1,700 points in a single day. Allies such as the European Union, South Korea, and Japan dismissed the warning altogether, signaling a deepening rift. These international tensions are hitting close to home for millions of American investors and retirees. The stock plunge wiped out substantial value from pension and savings accounts. Exporters now face sudden uncertainty, and businesses that depend on global supply chains are reporting delays and rising costs. The sense of instability is growing, not just abroad, but in every American household, watching their financial future shake. A Congressional Budget Office analysis found that 92% of tariff costs have been borne by U.S. companies, not foreign governments. Despite Trump's claims, the economic impact is domestic. Prices of imported goods from China, Mexico, and India have risen 5 to 19%, making essentials like electronics and building materials more expensive for U.S. consumers. Small businesses are bearing the brunt. In April alone, thousands of small firms filed for bankruptcy, especially in rural areas that once formed Trump's strongest voter base. For these business owners, higher input costs mean layoffs, shuttered storefronts, and shattered dreams. For everyday Americans, rising prices at the checkout counter are becoming a weekly headache, fueling frustration and financial strain. Trump promised 90 deals in 90 days, but no formal trade agreements have been signed. Allies like Japan and South Korea have paused talks, while Canada secured a $14.2 billion LNG deal with China, bypassing the U.S. entirely. Growing skepticism about U.S. stability is driving countries to seek more reliable trade partnerships. This erosion of global confidence affects workers and companies across the nation. U.S. manufacturers are being sidelined, losing bids to foreign competitors. Farmers and tech firms are seeing contracts diverted overseas. In the long run, fewer trade deals mean fewer jobs and reduced global influence for American industry. Under pressure, Trump postponed new tariffs for 90 days on April 15th, excluding China. But the move came too late for many businesses. Home Depot canceled $60 million in orders, GE halted expansion, and private sector investments slowed due to volatility and uncertainty. This economic chill is already visible in towns and cities nationwide. Construction is slowing, hiring is cautious, and consumer confidence is faltering. While the tariff delay offers a short-term reprieve, American businesses are still grappling with the aftershocks and wondering if another sudden shift is just around the corner. Intense negotiations between the U.S. and China in Geneva have concluded with a framework agreement aimed at temporarily easing the trade war, yet, with gold prices hitting record highs and American businesses continuing to warn of policy risks, the question remains, is this truly a victory for the U.S. economy? On May 12, 2025, after 2 days of negotiations in Geneva, the U.S. and China reached a temporary agreement to reduce tariffs for a 90-day period. Under the deal, the U.S. lowered tariffs on Chinese goods from 145% to 30%. China reduced its tariffs on U.S. goods from 125% to 10%. The tariff reductions are expected to ease price pressures on imported goods, especially in sectors like toys, apparel, and electronics. However, The 30% U.S. tariff remains significantly higher than previous levels and may continue to affect consumer prices and product choices. The agreement includes a phased tariff reduction mechanism contingent on China fulfilling commitments to open its markets and end currency manipulation. However, prominent U.S. business leaders, including Warren Buffett and Jamie Dimon, have voiced concerns. High tariff levels are hurting domestic companies, and there's a lack of transparency in trade policy. The uncertainty surrounding trade policies could lead to price volatility and weakened consumer confidence. As a result, American consumers may continue to face unstable prices and limited product choices, at least in the near term. President Trump signed an executive order aimed at maximizing the extraction of minerals, timber, and seafood in Alaska. The move boosted shares of gold mining companies like U.S. Gold Mining Inc., USGO, with gold prices soaring to a historic high of $3,400 per ounce in early May 2025. Rising gold prices may increase production costs in industries that rely on gold, such as electronics and jewelry, potentially leading to higher prices for consumers. While the temporary U.S.-China trade agreement has eased tensions and provided short-term benefits for American businesses and consumers, the core issues in bilateral trade relations remain unresolved. U.S. consumers should be prepared for further policy shifts and market volatility ahead.
President Donald Trump has stirred significant discussion in the political arena with his pragmatic foreign policy approach, where the United States, China, and Russia dominate global influence. The question remains, can this strategy reshape the global order? Or is it a risky move by Trump? In early 2025, President Donald Trump proposed renaming the Gulf of Mexico to the American Gulf, arguing that the region holds strategic importance for the U.S. He emphasized the Gulf's vital role in maritime trade and resource extraction, particularly oil and natural gas. This proposal caught the attention of the Mexican government, with President Claudia Sheinbaum expressing concerns that the name would be inappropriate and disrespectful to the region's historical heritage. Mexico has since made efforts to protect the name Gulf of Mexico on international maps. Throughout his presidency, Donald Trump developed a unique relationship with Russian President Vladimir Putin, even amid escalating tensions over the situation in Ukraine, where Russian forces continue their offensive. Meetings between Trump and Putin, especially the 2018 Helsinki summit, sparked controversy among international observers. Trump not only refrained from criticizing Putin for his interference in the 2016 U.S. elections, but also proposed closer cooperation between the two nations. Recently, Trump has again criticized U.S. foreign policy, suggesting that he might be the only leader capable of resolving the Ukraine conflict swiftly, though many view this stance as unrealistic, given the ongoing conflict and unresolved tensions between the two nations. Trump's leadership style, often described as transactional, has raised considerable debate. Throughout his term, he predominantly approached both domestic and international issues from the perspective of personal and national interests, rather than moral values or long-term leadership principles. He frequently sought short-term deals beneficial to the U.S. A clear example of this was his approach to trade relations with China, where he imposed high tariffs on Chinese goods, relying heavily on the power of sanctions and tough negotiations, rather than seeking long-term cooperative agreements. His views and actions have not always been predictable, and their instability has led to concerns about the absence of an overarching strategy in foreign policy. Donald Trump has made notable efforts to facilitate ceasefire agreements in the Middle East, particularly in the Israel-Gaza conflict. One of his significant actions was negotiating and facilitating a ceasefire agreement in early 2025 between Israel and Palestinian forces. However, his proposals, especially regarding Gaza's future, met with strong opposition from hard-right Israeli groups, who criticized him for not adopting a tougher stance toward Gaza and Palestine. Despite these reactions, rumors suggest the possibility of a new ceasefire agreement, potentially tied to Trump's upcoming visit to Saudi Arabia next month. President Donald Trump holds a clear strategic vision for the global power structure, which he believes will be dominated by three major powers: the United States, China, and Russia. In Trump's view, these nations will take center stage in global affairs, with the U.S. intervening in strategic regions, including the Asia-Pacific, the Middle East, and Europe. He focuses on safeguarding American interests, particularly through hardline trade strategies with China, aimed at reducing trade deficits and protecting domestic industries. Simultaneously, Trump has shown a degree of support for Russian policies, especially in Ukraine and Syria, reflecting his pragmatic foreign policy approach that prioritizes short-term agreements. Consumer prices in China have seen the steepest drop since 2009. Millions of workers are losing their jobs. Over 20,000 factories have shut down in just a few months. Meanwhile, Washington has slapped a 145% tariff on Chinese goods. How far will this crisis go? And how should the U.S. prepare? China's economy is spiraling into a prolonged deflationary cycle, marked by falling consumer prices, a collapsing real estate market, and surging public debt. In March 2025, the Consumer Price Index dropped 1.3% year over year, the sharpest decline since 2009. According to China's National Bureau of Statistics real estate, once 25% of GDP, is now dragging the economy down. Giants like Evergrande and Country Garden have gone bankrupt, leaving thousands of projects unfinished. According to Bloomberg, this crisis resembles the 2008 global financial crash, but it's slower moving and potentially more severe. Why? Because of China's opaque financial system and a shrinking population. For Americans, a weaker China might mean cheaper imports, but it also risks supply chain disruptions and reduced demand for U.S. exports. As of April 15, 2025, the U.S. Department of Commerce has imposed punitive tariffs up to 145% on Chinese steel, aluminum, and electric vehicles. According to CNBC, major U.S. firms like Tesla and Caterpillar have canceled orders. Why? Soaring costs and supply chain chaos. The fallout: thousands of Chinese factories have shut down. In Guangdong and Jiangsu alone, more than 20,000 factories have ceased operations since February. According to China Labor Bulletin Chinese media report, millions of workers now face layoffs or unpaid wages. It's a scene reminiscent of the early days of the COVID-19 pandemic. For the U.S., these tariffs help protect domestic manufacturers and boost union jobs, but they also raise concerns about rising consumer prices and shortages of imported electronic components and EV parts from China. As the economic crisis deepens, Chinese citizens are bearing the brunt. Countless small businesses are reporting record losses and can't even afford to pay employees. Factories are delaying or slashing wages. Youth unemployment has hit 21.3% among recent college graduates as of March 2025, the highest in a decade, according to China's Ministry of Human Resources. Financial Times. One viral case in Shanghai shows just how bad it is. A young master's degree holder submitted over 8,000 job applications over several months without landing a single offer. It's a stark reminder of the mismatch between academic training and real-world hiring needs. As unemployment rises and household incomes fall, U.S. economists are warning there's a real risk of social unrest in China, and that could shake global markets and rattle investor confidence across emerging Asian economies. In early April 2025, China announced it would suspend all new Boeing aircraft purchases, citing national security concerns. But Chinese leaders are still flying on Boeing 747s during state visits. That contradiction has sparked backlash from U.S. lawmakers, calling it hypocritical, renewing accusations of trade law violations and intellectual property theft. The Biden administration has vowed to tighten WTO enforcement and says if China wants to keep trading with the U.S., it must play fair. Analysts warn, if tensions escalate, the global aviation and tech sectors could face serious disruptions, as the two economic powers remain deeply tied in global supply chains. Financial markets are rattled as the U.S.-China trade conflict enters an unprecedented phase. Interest rates are climbing, and the U.S. dollar is losing ground. What lies ahead for the American economy? As of April 11th, U.S. financial markets have experienced notable declines. The S&P 500 has dropped 8.8% since the start of the year, while the NASDAQ composite has fallen 13.4%. The Dow Jones Industrial Average is also down 5.5%. Alongside equities, the yield on 10-year U.S. Treasury bonds has climbed to 4.5%, reflecting concerns over inflation and potential future interest rate hikes. The U.S. dollar has weakened, particularly against the euro and the Japanese yen. In contrast, gold prices have increased as investors shift to safer assets in response to currency depreciation and ongoing market instability. Over the past week, President Donald Trump announced a significant increase in tariffs on Chinese goods, bringing the total rate to 145%. This includes a 10% base tariff, a 125% reciprocal tariff, and an additional 20% aimed at addressing fentanyl-related issues. These measures are intended to encourage domestic manufacturing and reduce reliance on foreign supply chains, especially in critical sectors such as semiconductors and pharmaceuticals. China responded by raising tariffs on U.S. imports to 125% and stated it would not escalate further, regardless of future American actions. Additionally, China has imposed restrictions on the export of key resources like rare earth minerals, impacting U.S. defense and high-tech industries. These developments have contributed to global market fluctuations, with record gold prices, rising bond yields, and a continued weakening of the dollar. Across Europe, several countries are actively exploring deeper economic ties with China. Recent talks and agreements between the European Union and Beijing underscore a growing shift in international trade dynamics. One prominent area of cooperation is the electric vehicle sector. The EU and China are discussing the implementation of a minimum pricing mechanism for Chinese EVs imported into Europe, which could replace the current high tariff structure. Previously, the EU imposed tariffs of up to 35.3% due to concerns about state subsidies, but the ongoing negotiations aim for a more balanced and sustainable solution. Beyond EVs, discussions are also advancing in renewable energy and clean technology. During a recent visit to Beijing, Spanish Prime Minister Pedro Sánchez highlighted the importance of strengthening bilateral trade and investment in these emerging sectors. President Trump came under scrutiny last week following a social media post made on April 9th via Truth Social, in which he stated, "Now is a great time to buy," alongside the stock symbol DJT, referring to Trump Media and Technology Group. Just hours later, the administration announced a partial delay in retaliatory tariffs, maintaining a 10% base tariff on most trading partners. The timing of the post prompted concern from several Democratic senators, including Chuck Schumer and Elizabeth Warren, who have called on the SEC to examine whether the post may have provided an unfair advantage to those close to the president. On April 9th, DJT shares surged by 21.67%. Additionally, a video shared by White House communications aide Margot Martin appeared to show President Trump suggesting that some of his associates had benefited significantly from the market activity, raising further questions about potential misuse of privileged information. According to data from Freddie Mac, the average 30-year mortgage rate in the U.S. has fallen to 6.62%, marking the third consecutive week of decline. Despite this, broader economic sentiment remains fragile. The University of Michigan's Consumer Sentiment Index dropped to 50.8 in April, down from 57.0 in March, reaching its lowest point since 1981. At the same time, short-term inflation expectations rose to 6.7%, reflecting growing concerns over rising living costs and economic uncertainty. Major financial institutions, including Goldman Sachs, have revised their outlook, raising the probability of a U.S. recession in 2025 to 35%. These projections are driven by the combined impact of trade policy uncertainty and continued market volatility. EU diversifies partners, looks to internal market to counter potential 144 billion euros loss. Could these strategies safeguard Europe's supply chains and global standing against pressure from Washington? In 2023, the European Union was the world's largest trading power, accounting for 16.1% of global trade, valued at 7.6 trillion euros, according to Eurostat 2024. The U.S. remains the EU's largest trade partner, representing 17% of EU trade, equating to 1.6 trillion euros. However, this trade relationship lacks any free trade agreement, FTA, protection. Under former President Donald Trump, the U.S. imposed tariffs of up to 25% on imported cars from the EU and 10% across the board. Alarmingly, Trump's trade advisors are suggesting a return of a 20% tariff on all EU goods within the first 3 months if he re-enters the White House, according to Bloomberg. According to the European Commission, a retaliatory tariff war at 25% could reduce EU exports to the US by 17.5%, causing a direct loss of 0.54% of the EU's GDP, which is equivalent to 144 billion euros, according to a European Commission trade impact study. US consumers would face sharp price increases on imported goods from Europe, including cars, wine, and industrial equipment. The Brookings Institution predicts core inflation could rise by an additional 0.3 percentage points if these tariffs are reinstated, according to Brookings. To reduce dependency on the US, the EU is accelerating FTA negotiations with emerging economies. India is a top priority. If an FTA is concluded, the import tariff on cars could drop from over 100% to just 10%, according to Reuters. Bilateral trade between the EU and India is projected to reach 167 billion euros by 2026, with EU exports totaling 75 billion euros and imports from India reaching 93 billion euros. Additionally, a deal with Mercosur, Brazil, Argentina, Paraguay, and Uruguay could boost total trade to 126 billion euros, with the EU exporting 77 billion euros and importing 49 billion euros. For Mexico, improving market access alone could increase EU exports by 20%, or 10 billion euros. In total, if all 3 FTAs are approved before 2026, the EU could recover around 91 billion euros, though it would still fall 53 billion euros short of the losses from the US. Alongside expanding partnerships, the European Commission is calling for improvements to the EU's single market, established in 1993. While barriers to goods have been removed, 3 key pillars, services, capital, and labor, still face significant hurdles due to national laws. For example, Polish plumbers must recertify to practice in Belgium. Startups in Portugal struggle to raise funds from the Netherlands due to differing investment laws. And EU citizens face bureaucratic obstacles when working in other member states. According to a new study by the European Parliament, this lack of integration costs The EU, 1.1 trillion euros annually, 279 billion euros from services, 415 billion euros from the digital market, 300 billion euros from goods, and 50 billion euros from public procurement, according to European Parliament policy study. If reforms are implemented, the EU could fully recover the 144 billion euros loss from US tariffs, while also boosting its internal competitiveness. Canada is severing vital ties with the United States, from energy and security to politics. What is happening after the statement? Canada is the 51st state. And why are citizens calling for national self-defense? Manitoba Hydro, one of Canada's major energy providers, has terminated 2 electricity export contracts to the United States equivalent to 500 megawatts per day, following former President Donald Trump's announcement of a 25% tariff on Canadian energy and goods. The redirected power will now serve domestic regions such as Nunavut, Saskatchewan, and Ontario. The Manitoba provincial government stated this move is part of an effort to reclaim energy sovereignty amid ongoing trade dependence on the U.S. However, the decision may leave Manitoba Hydro facing up to CAD $25 billion in debt, prompting the company to propose an 11% electricity rate increase, starting in 2026 to offset revenue. Losses residents in Manitoba and Ontario may face increased financial pressure as electricity prices rise during a time of climbing living costs. The exit from the U.S. energy market also presents long-term questions for Canada regarding energy security and export diversification. Amid rising trade and political tensions between Canada and the United States, former President Trump has repeatedly referred to Canada as the 51st state. This rhetoric has raised concerns about bilateral relations and Canada's national security. Canadian Prime Minister Mark Carney publicly rejected President Trump's remarks, emphasizing the importance of defending Canada's sovereignty and independence. He also called for increased defense spending and reduced reliance on the U.S. in security matters. Both the Liberal and Conservative parties have expressed support for strengthening national defense and diversifying international partnerships. In Canada's Parliament, some members question whether NATO would intervene in the event of a conflict between Canada and the U.S. Under Article 5 of the North Atlantic Treaty, NATO responds only when a member is attacked by an external force. As such, a dispute between 2 NATO members may not prompt intervention, raising concerns about Canada's independent defense capabilities. Many Canadians have expressed anxiety about the future of the country and its relationship with the United States. Citizens are urging the government to strengthen ties with other international partners and invest in national defense to safeguard sovereignty and security. Canadians are increasingly aware of the need to reduce dependence on the United States and strengthen national autonomy. U.S. tariff policies and controversial statements by President Trump have fueled a wave of nationalism and a call for broader international engagement. A survey by Angus Reid found that 91% of Canadians support reducing reliance on the U.S., while 90% oppose the idea of Canada becoming the 51st state. In response, many citizens have joined Buy Canadian campaigns, boycotted American products, and canceled travel to the U.S. apps like MapleScan. And Buy Canadian have grown in popularity, helping consumers identify local products. On the political front, Canadian parties are advocating for increased defense spending and stronger relations with international partners. However, efforts to diversify markets and reduce U.S. dependence face several challenges, including high defense costs and geographic distance from alternative trade partners. A new type of battery is drawing serious attention across the electric vehicle industry. Could this be the beginning of a new era of ultra-affordable, long-lasting, and safer electric vehicles? Contemporary Amprex technology Co-Limited CATL, the world's leading battery manufacturer, has officially unveiled its next-generation sodium-ion battery line named Naxtra. This marks a significant technological advancement in the field of energy storage. Naxtra batteries reach an energy density of 175 UHkD, the highest ever recorded for sodium-ion technology, and on par with current lithium iron phosphate LFP batteries. This allows electric vehicles powered by sodium-ion batteries to travel up to 500 kilometers on a single charge, making them viable for both pure electric and hybrid mode. Remarkably, these batteries can endure more than 10,000 charge-discharge cycles, far surpassing